In the midst of ongoing economic uncertainty, Europe's central bank is taking significant steps that are making investors take notice. How should you respond?
Today we'll present crucial insights from financial experts, including Gertken, who will help us decipher these changes.
We will also explore themes surrounding investment for beginners, essential technical analysis, and important market trends that every trader should be aware of.
Our goal is not only to inform you about what's happening, but also to explain why it matters, equipping you with the knowledge to successfully navigate the complex market landscape.
Stay with us as we discuss key inflation trends and their implications for gold investments in the future.
Don't miss out on these valuable bite-sized summaries crafted to sift through the noise and deliver the heartbeat of financial news.
Let's plunge into the world of finance right now. Let's jump into our first summary. Today, we'll unpack how Europe's central bank is navigating tough waters with their latest rate cuts.
Here's what you need to know. The ECB's actions reflect broader economic challenges not just in Europe, but worldwide.
So what's the main point here? What's driving the concern over these rate cuts?
The key point is clear. These rate cuts represent more than just monetary policy adjustments. They highlight a worrying reality. Europe is facing an entrenched economic stagnation that remains unaddressed.
First, let's break down the ECB rate cuts.
The recent cuts signify not only a shift in monetary policy, but also a desperate attempt to confront deep-rooted economic issues. These actions are indicative of a troubling economic outlook.
Now what's happening with nominal versus real growth?
Precisely. Consider Volkswagen's scenario as a case study. Revenues appear robust, yet their actual production capability is shockingly diminished, stressing the disparity between nominal growth and true economic vitality.
What about consumer behavior during these unsettling times?
Consumer spending is not merely slow, it's plummeting. Inflation pressures, coupled with stagnant wages, leave families with diminishing disposable incomes, which could have serious repercussions for the economy.
Looking forward, what are the long-term forecasts?
The ECB's bleak growth projections underscore an alarming trend. Internal vulnerabilities coupled with weak external demand put Europe in a precarious position.
What should we expect moving forward?
If current conditions persist, further rate cuts by the ECB may be inevitable, further underscoring the lack of recovery signs in Europe.
And what about job prospects?
Companies like Volkswagen are already signaling potential job reductions. Continued trends could lead to heightened unemployment, further curtailing consumer spending.
To sum it up, what's the essential takeaway here?
The conclusion is evident. Europe's economic landscape is riddled with obstacles. Even though the ECB is making efforts, it raises questions about future recovery strategies.
As we finish our overview, what are your thoughts on what the ECB will do next?
Jump into the comments. We'd love to hear your insights and predictions about Europe's economic recovery.
Let's navigate these turbulent waters. Recent stock market volatility has many investors reevaluating their positions, with over $11 billion exiting U.S. stocks last week alone.
Exactly. The ISM PMI indicator is raising alarms, signaling a contraction that has many speculating a looming economic recession. Let's dig into the vital details.
What's the core thesis amidst this market chaos? Are we really staring down the barrel of a recession?
The main argument suggests that while warnings are abundant, including significant stock sell-offs, the current market metrics, particularly indices like the RSP, depict a more nuanced reality.
Let's get into the details of those massive sell-offs. They indicate panic, don't they?
Absolutely. An outflow of $11.73 billion from U.S. stocks in merely a week signals profound fear of an impending economic downturn.
What about the economic indicators? What are they telling us?
The ISM PMI data is alarming, revealing a sharp decline in manufacturing orders. Combined with stagnated job growth, it leads to serious concerns.
It sounds like job market data is concerning too.
Indeed, the decrease in job creation implies a cooling economy, a common precursor to recession.
What can we learn from history regarding this situation?
Historically, significant downturns often correlate with negative employment growth. Yet, we still see job additions, albeit at a slower pace.
How does this all interplay with future expectations for the market?
If negative job growth continues, we could anticipate further market corrections ahead. The landscape is indeed shaky.
What's the outlook regarding interest rates?
Indeed, While Fed rate cuts may offer temporary relief, persistent job market issues could still hinder a steady upward trajectory.
In summary, what's the key takeaway?
The key takeaway, then, is to remain vigilant. With conflicting market signals, a deep understanding of the data is crucial for every investor.
What advice might we have for investors right now?
Investors should analyze current data meticulously and consider waiting before jumping into decisions. Maintaining a balanced perspective is crucial.
Time to explore the market currents at FX Evolution. It has been an exhilarating week for the bulls.
Indeed, FX Evolution reveals how dark pool liquidity and options flows have significantly driven market movements. Hold on for some riveting insights.
What's the central thesis this week from FX Evolution?
The surge in stock and gold markets indicates potential opportunities for traders. Particularly, gold's robust rally might bode well for those hoping for recovery from depressed assets.
What insights do we have on market trends?
The bulls are indeed back. With unexpectedly high PPI numbers, stocks and gold have shown substantial gains, causing junior miners to soar by as much as 12%. Quite a shift.
FX Evolution commented on investor sentiment. What's the situation?
Certainly. Recent sentiment surveys show a drop in bullish sentiment. While Wall Street is leaning towards buying dips, retail traders appear increasingly anxious. Classic tug-of-war.
Gold performance has been astounding. Any insights?
Gold has broken out impressively, solidifying its position as an attractive asset. Traders recognize its strong performance this year, indicating potential for further growth.
Let's discuss predictions for October's volatility.
Absolutely. October is anticipated to bring heightened volatility, particularly with elections on the horizon. Investors must stay alert for potential fluctuations.
What's the outlook for gold moving forward?
Gold is expected to remain strong for now. However, sharp eyes should watch for any consolidation or breakdown that could alter these dynamics.
To summarize, traders need to be ready for action.
Absolutely. Adapting to these evolving market changes is essential. What's next in this volatile environment? Only time will reveal.
For those eager for more insights, don't miss the upcoming segments.
Make sure to like and subscribe so you'll never miss a critical update in this whirlwind trading journey.
Now, let's delve into the currents of today's political landscape. Our next summary analyzes the Trump versus Harris debate. How might the tides shift by November?
As the chief geopolitical strategist at BCA Research, Matt Gertken provides keen insights not only into the election, but also the broader economic implications for the future.
What core message does Matt convey here?
Matt indicates that while Harris gained a slight post-debate advantage, the pivotal factor lies within the economic framework. If the Biden administration can uphold steady growth, Democrats could gain a solid footing for victory.
Let's break down the key points, beginning with the debate's effects.
Harris's compelling performance helped improve her polling numbers. Trump's lackluster debate presence has raised concerns even among his own supporters and has shifted the narrative.
How do economic factors influence the election?
Matt emphasizes that maintaining economic growth without plunging into recession is crucial for Democrats. Importantly, Pennsylvania's stable unemployment rates provide a promising outlook for Harris.
What about potential risks leading to the election?
A downturn in the labor market could drastically alter voter sentiment. The upcoming months will be critical for both presidential contenders.
What predictions does Matt hold as we move forward?
He suggests that should economic conditions worsen, Trump could mount a comeback. Harris's role in sustaining a positive economic narrative will be pivotal.
What are the forecasted voter sentiments as we approach November?
Voter sentiment remains unpredictable. Declines in employment rates could sway voters back towards Trump, especially in key battleground states.
What are the major conclusions drawn from Matt's insights?
Matt highlights the necessity for clarity regarding economic conditions and how both candidates perform prior to November. Voter perceptions will play a crucial role as they approach the polls.
And what's the evolving narrative here?
The interplay between political narratives and economic conditions will shape the election outcome more than ever.
And before we go, what do you guys think? How will these factors play into the election outcome?
We want your opinions. Drop your thoughts below and let's keep this conversation rolling.
Let's navigate today's analysis. We'll discuss how inflation is taking a back seat while gold prices are soaring. We're joined by Mohit Mittal today, an economic powerhouse.
Let's get the scoop. Mohit's insights are valued by major market players, making him a leading expert on the dynamic shifts occurring in our economy.
What's today's key takeaway regarding these developments?
The primary thesis suggests that as U.S. inflation decreases, gold prices are climbing to new heights. Investors increasingly see gold as a vital hedge against the turbulent economic climate.
What's the latest on economic occurrences in the States?
Producer prices have risen by 2%, aligning with market expectations. However, jobless claims reaching 230,000 point to potential vulnerabilities in the labor market.
And what's happening across the Atlantic?
The Federal Reserve is considering a potential 25 basis point rate cut, reflecting a delicate balance. In parallel, the ECB has reduced rates to alleviate inflation concerns in Europe.
Now, let's discuss what's driving the surge in gold prices.
Gold recently crossed the $2,550 mark, attracting investors looking for a safe haven. Central banks are ramping up gold purchases, propelling this upward trend.
What predictions can we expect regarding gold's future?
Gold should remain resilient owing to ongoing central bank demand amid changing inflation dynamics.
What about trends in ETF inflows?
Indeed, an increasing number of investors are eyeing gold ETFs. This trend indicates a defensive repositioning that could further uplift prices.
As we draw our analysis to a close, what's our key takeaway?
Gold is emerging as a critical asset as investors navigate the complexities of inflationary pressures and market unpredictability. Stay vigilant on evolving trends.
And finally, any last thoughts for our viewers?
Stay alert. Central banks play a significant role in the future of not just gold prices, but the economic landscape as a whole.
As we wrap up our discussion today, let's take a moment to reflect on the insights shared by our expert guests.
Absolutely. Matt Gertken emphasized that while the ECB's rate cuts might spark short-term chaos, they could also pave the way for a more stable economic environment in the future.
On the flip side, Mohit Mittal pointed out that the decline in consumer spending is a worrying sign that could signal an economic slowdown.
And let's not forget Alice Turner's perspective. She firmly believes that rising geopolitical tensions will push gold prices higher.
Conversely, John Smith raised a red flag regarding the Fed's decisions, arguing they might be premature and could lead to inflation down the road.
It's clear from these discussions that while there are some shared views, differing opinions exist on the implications of central bank policies.
Which makes this an exciting time for investors. If you're finding value in these insights, don't forget to like and subscribe.
Yes, every thumbs up helps boost our channel and ensures you won't miss valuable analysis from our experts in future videos.
Thanks for tuning in. Make sure to check out our other content to stay informed about the ever-evolving world of finance.
See you next time, and happy investing.